On Wall Street, algorithmic control isn't just a best practice, it's a legal requirement. Here, every autonomous decision must be traceable and auditable. At the Federal Reserve, scrutiny of AI systems is a standard part of bank examinations, treating model drift as a systemic threat. OCC regulators probe vendor contracts, demanding to know who has the authority to pull the plug if an AI acts outside its intended scope. In this environment, the government provides a clear safety net by mandating that institutions prove they maintain absolute control over their tech. But in cities like Nairobi, the landscape is different. Formal AI playbooks used in the West are missing, and oversight is still catching up. This is a high-velocity economy, where mobile money ecosystems handle the daily finances of millions through informal and fragmented networks. This raises a difficult question. What happens to an autonomous AI managing microloans and remittances when there are no official watchdogs to oversee it? The lack of oversight doesn't mean the risks disappear. It means the cost of a mistake falls entirely on the provider. In these markets, a single automated error can erase a platform's reputation before it even has the chance to scale. Instead of government rules, three invisible forces govern the vacuum. The first is desirability, the simple measure of whether a community trusts a machine with its livelihood. Imagine a worker at this kiosk using an AI agent to route a remittance home. If that agent moves her funds through a series of black box steps she can't follow, she won't just be confused, she'll stop using the app. In frontier markets, word of mouth travels faster than any marketing campaign. To keep customers, the platform has to provide clear reasons for every decision, showing exactly why a loan was denied or how a specific route was chosen. This transparency transforms an opaque algorithm into a tool that local merchants and families can actually rely on. On the frontier, user-centric design isn't a stylistic choice. It's a necessary defense against a sudden run on the platform. The second major constraint is commercial viability. Major liquidity providers and global investors avoid environments they perceive as chaotic. To access the capital needed to grow, a platform has to prove it won't collapse. This leads to shadow compliance. Platforms voluntarily build their own data privacy silos and fraud detection systems to meet the expectations of international partners. These investors look for the same kill switches and governance structures that Western regulators demand. The need for external capital forces the platform to adopt institutional-level oversight as a condition of its own existence. Finally, there is the reality of what the technology can actually do in the local environment. In cities like Dhaka, developers face spotty connectivity and a lack of clean, historical data to train their models. There is also the threat of external control. A Western government can disable a cloud-based AI model overnight, leaving a local fintech with a dead dependency. This forces teams to build sovereign edge AI that can run locally and fail safely, ensuring users don't lose access during a network drop or a model shutdown. Infrastructure limits prevent a reckless approach to software, because on the frontier, when things break, they stay broken. This is where these three forces meet. When user trust, risk mitigation, and technical stability align, the platform becomes resilient. Stepping outside this overlap leads to immediate trouble, either by alienating the user base or by quickly bleeding through capital reserves. These guardrails aren't built for altruism. They are the minimum requirements for a business to stay solvent in a high-risk environment. The absence of a government regulator doesn't grant immunity from risk. It simply shifts the entire burden of enforcement onto the platform. If it can't police itself, the market will do it instead.